Hi, everyone. Thank you for joining us today. I'm Sarah Van Wagenen with TMC. I'm going to give everyone a couple minutes to hop on here. Today we have diving into HMDA data West Coast edition with Laird Nasuli, CEO of iEmergent. If you guys have any questions at all during this webinar, please drop them in the chat and Laird will address them. And if you have any questions after the webinar, we will also be sending out a follow-up email with Laird's and iEmergent's contact information, along with the deck from the presentation today.
All right, so I need to see full screen, right? But you don't want that. You want to see just the screen. Where is it going? We just had this right, Sarah. That's the fun part. Hide self view.
I
Can you
see
see that? Can you see the deck?
I see your deck, yes.
All right, well, I don't, so we need to fix that. Okay. Then now now I see the deck. Good. That's what needs to happen. So you ready for me to get started?
Yep. All good to go.
All right. Well, good afternoon, everyone. As Sarah mentioned, we're going to talk today about the 2023 HMDA data and specifically going to focus on the West Coast. To be completely honest, it's not going to be only the West Coast. It's going to be what I'm calling the Western region. So in addition to the actual coastal states, we're going to look at Nevada, Utah, and Arizona, and Idaho too. So anyway, I don't know if you've joined me for the last couple that I've done. I did one for the East Coast and one for the Central region. And we're now, last but not least, going to tackle the West Coast. I'm going to talk a little bit about, the overall originations picture. Then I'm going to dive into some state detail, then some metropolitan area detail. And then at the end, which is the most interesting stuff, we're going to look at some changes in lender share and some differences in how lenders and markets are behaving with diverse markets. So without further ado, I'm gonna jump right in. So one of the things that we like to do when we're looking at the HMDA data, especially when it comes out, is it's important to look at it on its own, but it's always important to look at it in the context of a bigger picture. And so what I've done with the chart you see right now is I am looking at how does 2023 in purchase and refi combined compared to the last basically 2 decades worth. So we go back to 2008 and I go forward at this chart to our 2028 forecast. And the darker blue is the purchase loan units. So these are going to be the loan units down here. And up on top is the refinance units. And even without looking at any details in terms of numbers, you can easily see, first of all, how giant 2020 and 2021 really were in terms of originations, and obviously driven, as all of you probably know, by refinance. What you can see that's, I think, more pertinent to what we're talking about today is overall a relatively stable purchase market. Looking at actual counts, 2023 came out to about 3.4 billion units, purchase units. I do want to clarify that, though. That is single family 1 to 4. We're not looking at at repurchases with this. This is really just your origination market, single family 1 to 4, both sets of liens and both occupancy or all occupancy. So that's what we're looking at. And if you look at that 3.4 this year, the closest to that we had 3.2 and 3.1 in 2008. 2013 and 2014. So I know those were considered smaller years, but you can see that even though there's these hugely volatile refinance years, we are kind of returning to, and it's a little bit of a dip down with the 2023 purchase. But the good news is when we look at our forecast, we're going to see the market slowly climb back to what we consider to be the purchase market's trend line. Long-term trend line. So even though it feels really, really different. In reality, these drops are part of a normal cycle to an extent. Now, the refinance drop is what, we felt so strongly from 2021 to 2022, but you can see the drop when we're looking at 2022 to 2023 wasn't as drastic. And so if we're going to actually quantify these and look at real numbers, from 2022 to 2023, we saw about a 21% drop in purchase, that huge 59% drop in refi, and that averaged out to about a 35% drop overall. Contrast that, though, when you look at the 21 to 23 change, and again, this is the whole US, 36% in purchase and that 88% refi. So total originations from 2021 to last year dropped about 68%. Slightly lower if you're looking at the same information, but for mortgage dollars. Some of that is because as the units dropped, average loan sizes did not. So that's why we see a little bit smaller drop in the 21 to 23, change when we're looking at dollars. So this is the US. Now, if you go to and look at just the Western region, which again were the states that I mentioned earlier, it's 9 different states, you can see a similar look. It may look like it's less drastic. Part of that is just because the scale is not as wide. But you can see here, looking at numbers, we look at the Western region in units, the drop in purchase up 27%, refi 70%, and then overall 46% drop. Now, there's obviously different than the US. When we go through all this information, I noticed that the refi drop took longer to really impact the West Coast as much. So it's a little bit slow, and that's why we see a bigger drop in refi when we're looking at the Western region than if we're looking at the whole US. And same kind of the same concept here with dollars. Actually, in this particular on the West Coast, the dollars were slightly steeper, which is a little bit of a surprise because overall we didn't see that. So that's sort of how it fits into the big picture. And what you see now, the total loans by state and total dollars by state really show visually a comparative picture of, what we're looking at on the previous chart, or specifically this 2023 snapshot in time. And this is probably no surprise, which of these states are the biggest in terms of loan units. California and Arizona. California had almost 330,000 loans, purchase and refi loans in 2023. Almost half of that, Arizona at 117, Washington at 101, and then the rest sort of make up that difference. We're going to look at some heat maps throughout this presentation, and what I mean by that is think of the red, whether it's a county, whether MSA or a state. Red means a hot market, which is why we call this a heat map for fun, where there's more opportunity or more loans. And then the blue is less, so kind of a cold or a lower activity market if we're not looking forward. But then the interesting thing about these two images, though, are that when you look at units and then you look at dollars, even though California far and away is the largest in both, when you're looking at it both ways, you can see that Arizona and Washington kind of flip. And a lot of that has to do with, in particular, Seattle average loan sizes are really similar to what we see in San Francisco and LA. So just skyrocketing, huge loan sizes in that metro market, which really drives the dollars there. So that's why Arizona drops to 3 and Washington bumps up to 2. All has to do with what those property values and loan sizes look like. So if I go on to look at sort of the Western loan size change in, in loan size in the Western region versus the change in loan size overall, you can see this is again going back to 2008 up to 2028. we're looking at this. The blue line is the purchase line. The green line is the refinance line. You can see that, yeah, there are going to be some changes, and overall, the Western region has a higher average loan size. It starts off about $70,000 higher in 2008. That widens quite a bit to that peak in terms of the disparity was last year, and it looks like 515 was the average loan size, purchase loan size in the Western region, contrasted with 353 for the US. But what's interesting about this is that the overall trends look really similar. And when we looked at the central region, we looked at the East Coast, same thing. You know, we see that big bump in dollars in 2000, from 2020 to 22, and then, a slight drop in 23. But as you can see, moving forward, there doesn't look to be any slowing down with that, or not necessarily that. There's going to not be an increase in the increase, right? So we're not seeing home values drop, but we're seeing their speed of growth kind of lessen. So when we're looking at overall average loan sizes, purchase-wise, from 21 to 23, there's about a 4% increase in the West, 5% increase overall. Moving forward, again, over the 2023 to 25, the next 3 years, 6% increase in average loan size in the Western region and 9% overall. And some of that is because there are markets that there is more room to increase. I think you do see that in some of these high cost markets, there gets to be a point where there's just no more room to go up. So the increase is lower in terms of percentage, but still there's a significant upturn in those average loan sizes. This is just another look at the same thing. And what I like about this view, though, is it allows me to quickly see, if you look at the top chart, the darker blue is the purchase for the US. The light blue is purchase for the Western region. The dark blue is refi for the US. The light blue is refi for the region. Well, just looking at this quickly, I can see kind of what I said on the earlier chart, that purchase and refi in the region is higher. And in these cases, purchase is significantly higher than refi, pretty much starting in 2021. And then the bottom one is just a simple, if you look at overall, purchase plus refi, what is happening? Here you can see that widened spread, and then sort of that same uptick moving forward. And that average loan size is important to look at, just because it really helps explain, in some ways, if you look at property values increasing, it explains what some of the limitations may be on with affordability. Not only has the cost of credit gone up, but if we continue to see that hike in average loan size, which it mirrors in some ways, the hike in home price, that there's going to be limitations to the number of loans there can be based on how large they are, and what those properties prices are and who can afford them. So this is the same thing that we've been looking at. Just wanted to clarify, okay, if we look and we rank them, from biggest to smallest, those are the ones we looked at earlier. Then when we rank by growth, California drops to the bottom in 5-year growth, stays close to the bottom in the just from 2022 to 2023. But you can see still with all of them, big drops in growth. But the ranking shifts pretty considerably. And it's not a question of which one's growing the fastest. It's a question of which one lost the least. And the same thing in dollars. Again, you can see here, the smaller numbers really have more to do with the huge increase from 2018 to 2023 in average loan size. So another trend that I think there has been some considerable shift, really over the last 2 years, not just from 2022 to 2023, was this trend as rates changed, this increase in your true home improvement and HELOC / home equity lending. In 2021, that those loans to combine those from a loan purpose perspective, were about 7% of all originations. Well, and of course, 67% of that was refinance, with a big portion of that being cash out refi. Well, when those rates shifted, you can see that the products that shifted from in 2022, 19% of all originations were home improvement and HELOC home equity. And then in 2023, it might be a smaller count, but they account for 23% of all loan purposes. And one of the places where that matters a lot is if you start looking at lender purchase share or lender share, the kind of the prevalence or increase in the propensity and composition of this from fewer of that home equity and home improvement loans to more does sort of then we see that there's an increase in bank and credit union share. If you look just purely at purchase, it's dominated by IMBs. But when you start adding in those, you can see how overall the banks and credit unions, kind of maintained a little bit of share in the purchase market. Or, not in the purchase market, but as the market shifted away from refi to purchase. And so this is just that same concept, but instead of looking longitudinally over the years, what we're doing here is looking at the differences by state. I'll be honest, the disparity in between states surprised me. I hadn't expected there to be such a big difference in, like, for example, if you look at Alaska, had about 12% overall of the home improvement, home equity loans. Well, Utah was 29%. And so you see that shift and, trying to think about and spend some time on why that would be. But I think a lot of that has to do with the type of homes and the cost of homes in each of these different states. But that's, if you have this deck and you look through it, spend some time on that, because it's actually pretty interesting to look at how things have changed and how they change differently in each state. So now, kind of moving past the home improvement and the full set of loan purposes, we're going to focus now just on purchase and refi, and then move to look at just the purchase market. Again, by state, California in every single one of these state maps is going to be the biggest. So, there's no surprise there. But if you look here, this is similar to look at what we looked at earlier. Look at the rank by growth, both over the 5-year snapshot and moving forward. Contrast that with the dollars, same story, except that in dollars, Idaho jumps to the top when you're looking at just purchase and refi as opposed to all. And some of those growth numbers aren't quite so extreme. So I'm actually most interested in the purchase originations, though, because it's most closely mirrors what we're looking at for this year and the years ahead. It's great to look at the HMDA data. I love the HMDA data. I'm a complete nerd with it. But at the same time, I like it the most in the context of what it tells me about what's going to happen. And so, yeah, we had a huge refi year in 2021, but we're not going to have that in 2024 or 2025. So what is that purchase market doing? You can see, again, we don't have a ton of states to compare here, but when you look at just purchase, the rankings don't change a whole lot. Washington and Arizona flip, California stays on the top. But then the average loan sizes, there's a little bit of shift in that from what we saw when we were looking at the combined purchase and refi average loan sizes. This is just a detailed look about, at what we were just looking at there and how things change. What does it look when you look at growth? If you're looking at just purchase, Nevada actually jumps to the top from growth from 2022 to 2023, and Hawaii drops to the bottom. So I know that a lot of that has to do and is limited also by supply issues. So Nevada may have more, new construction, new inventory coming up for sale, that could also drive a more stable and a stronger purchase market than the markets where, you know, really supply is a limitation. Same thing by state. Nevada jumps to the top. And then when you're actually looking at growth in dollars over the snapshot, there was some growth from 2018 to 2023 if you're looking at just purchase. So this is more interesting though, the states, especially when you're looking at those giant West Coast states that have huge metro markets that are really like states of their own. Now we're going to jump and look at what it looked like from a metropolitan area. And, you know, again, kind of gets skewed because we've got San Diego, Phoenix, and LA and Seattle in this mix. They're going to jump to the top really no matter what, because comparatively they're so big. But you can see here, if we're looking just at loans and dollars together, you know, the first, you know, top three, LA, Phoenix, Riverside, San Bernardino, jump to the top. But then you look at how much the purchase and refi market has changed since 2023 or since 2022, you see some really big numbers. There's a lot of lost originations, a big shift at a market level when you start looking at how things have changed. Dollars shifted a little bit. You know, we had Riverside was on there when you're looking at loan count. But when you start looking at loan dollars, San Francisco takes its spot up there like it always does. And LA and Phoenix stay up top. And then you have Riverside, then Seattle, then San Diego. And then there's once you get past those, those few, there's a big drop when you start looking, almost a $2 billion drop when you start looking at San Jose and down. Average loan sizes, the same story. San Jose is huge average loan size, 578, which explains why it bumped up on the MSA ranking in size, but was lower in the loan unit. But, every time I look at these, I'm always just, kind of shocked at those average loan sizes, because imagine what they translate into from a property and home price index, or from a home price perspective. And then here we get to that purchase market, and we look at counts in the purchase market only. Phoenix tops out over Los Angeles. And that's a great example of where Los Angeles is more limited by supply. Phoenix, obviously there's some supply issue, but it still has room for expansion. And so it's easier to, really create the inventory for a more purchase growth than it is in Los Angeles or Riverside or Seattle. So that's how that plays out. Keep in mind, again, that when you're looking at the map, hot is, hot markets, bigger markets are red, and the smaller ones are blue. And there's the CVSA or the dollar look. Then you see that shift again. Phoenix drops down, Seattle jumps up, San Francisco jumps up. That relationship is really, really an important one to look at. So when you're looking at purchase too, we looked at those, like those $500,000 average loan sizes when you have purchase and refi combined. That's interesting, but these are just become whopping when you're looking at the purchase loans. They're significantly higher than sort of the balance between a purchase refi loan average. So now we get to the part that, if any of you listened to me talk before, you know that one of my favorite things to talk about is market segmentation and how we see things changing from a diverse markets perspective. And, in each of the three regions, it's apparent when you look at growth that as we stare down the next 5 to 10 years, growth isn't going to happen without engaging what is a growing part of our demographic, of our population. And so as the number of diverse households and people increase, I hope that the loans keep up with that. And the reason for that is, if they don't, and we continue to have more and more demand, but that demand isn't being met for, a variety of reasons, business is going to continue to slow down if, in fact, you are struggling as an industry to serve your most rapidly growing market segment. And what's interesting about looking region to region, when you look at Asian, the AAPI group, the Asian Americans and Pacific Islander group, the biggest that group has the biggest penetration rate of the three regions when you're looking at the West. From the perspective of, size, Los Angeles, Seattle. When we look at that penetration rate, you're going to see that this Asian population or market segment is not small. It is big, and it is, from an average loan perspective, the average loan size is higher than non-Hispanic white, and so is the median income. So this is a really important growing demographic. And you can see obviously, it makes sense that it's a really big portion in Hawaii, but in San Francisco, Seattle, more than a quarter of purchase loans are being originated to AAPI people. But what's even more interesting is that is not matching the demographics. The demographics are actually even higher. So there's still a slight gap in terms of who could be, where there is opportunity that's unmet. And just to keep that in mind, because if you're on the West Coast and you look at just what the heat map looks like, hopefully you're thinking about how well you're working with, the Asian and Pacific Islander population. Now, when you move to the Black household, sort of, the look for Black and African American households, it shifts a little bit. This group is sort of the dominant, well, not really the dominant group, but shares that dominant group, status in the Southeast with Hispanic households. When you go to the West Coast, the Black household composition does decrease a little bit. And, the top markets, the big markets that we always think about are no longer the ones with the highest percent minority. Like Las Vegas, you can see, Phoenix, you can see. If we're looking at just loan count, they actually produced more Black purchase loans than either Los Angeles, Riverside, or Seattle, despite the fact that those markets are, overall so much larger. And that really has to do with what the households look like, what the income looks like, what even the industry and occupation of those areas look like. And here's that same map. Again, right here, we're looking at just pure loan counts, purchase loan counts to Black households. This is looking at what percent of all loans originated in that market, purchase loans in each one of these markets, what percent of those were to Black households? And you can see those numbers drop. The highest is 11% in Vallejo. And then of course there's Las Vegas at 8%. And 8% is actually the national average for, I believe, for Black households and Black loans across the board. So it does show you that on the West Coast, that Asian composition, or that Asian penetration rate is sort of, the dominant driver. And then looking at Hispanic purchase loans, the big ones pop out again: Los Angeles, Riverside, and then obviously just because of just the count, Phoenix. But you can see that those numbers are much larger than when you're looking at the Black household or Black purchase loan counts. And then when you look at, with the exception of there's some markets where there's 76% in El Centro, Yuma. That's not much of a surprise in terms of just what a large part of the population and household pool is Hispanic. This again, to me is evidence that if you want to have a healthy growth strategy for your organization, this is a market segment you can't look away from. So the next kind of topic area that I dive into in this, and trust me, we could have gone many, many different paths, but I became interested this year in lender type. Don't know why that became such a big point of interest for me, but I really liked digging into that because what really, was revealed is that when you're looking at a state by state or market level of detail, it's pretty different, you know, and what I thought was unique, and I think it's shown well in the chart below. If you look at the percent of, like, say, count, so if you look at all the institutions that originated a loan, if you look at just their count, in this region, banks make up 34% of all institutions, again, from a count perspective. When you look at the percent, the market share, though, that 34% is originating only 19% of all purchase loans. Credit unions, 19%, but originating only 7% of all loans. And this is where you see that big shift where less than half of all IMBs, or less than half of all lenders are IMBs, but they account for 3/4 of the purchase loan share. Now, if you were looking at overall, this is what I mentioned at the beginning, that's where you see that kind of balances out a little bit because of the home improvement and home equity market share gain that banks and lenders, or banks and credit unions have. What I thought what I thought was really interesting, though, was that it didn't look the same state by state. So this pink, or this like light purple color here, in this chart, that is the IMB market share. So most of them, it's the highest. Then you drop down, and there's a couple places where the gap in market share is lower. And the other thing that's interesting is that just because, like, for example, California, 22% of all institutions in California are credit unions, but they have only 5% of the market share. Again, looking at purchase share only. And I just think that's a really interesting dynamic. And if you take it to the next step, you know, kind of, and look at it more deeply, there even are more shifts when you start looking at, and you overlap this with the race and ethnicity piece. And a lot of it has to do with what products are being used and things like that. But like, for example, credit unions have a high market share with the Asian American Pacific Islander population, much higher than they do with other borrower groups. So if you back into some of those reasons for why, and you look at, you know, what are typical bank products, what are typical credit union products, and what are IMBs offering, match that with a product look at race and ethnicity, and you see that alignment. But this chart is good at showing you the darker color of, you know, the darker blue, the darker green, the darker pink, purple. That's the count. And the lighter one is the market share. And you can really see that it's not exactly the same in every market. Oops. So kind of moving on, now kind of making that connection from, all right, how, you know, we look at that lender share, and then we can look at what I call lender coverage. And so talking about growth, talking about how well are we as an industry and our lenders serving these growing segments. I looked at what I call the lender coverage ratios. And what I was looking at is I was getting a count of all the lenders that have had at least one application received from the different groups. And so, for example, when I look at, we'll just use, I use Arizona. There are 900 different lenders that originated or that accepted at least one application in Arizona. So 900 purchase lenders, and that would give us what we call a LLR, or loan to lender ratio, or app to lender ratio of about 150 apps per lender. That 900 is the number, though, I want you to think about. When you look at the Asian applicants, only 354 different institutions accepted at least one application. So that means only 39% of all lenders had, you know, are what we call actively covering the Asian market. I think that's a pretty wide disparity. You can see that, you know, the bigger the market, the more diverse the market is, the more that active lender number kind of increases, but that's not enough to explain for that. So when I look at this, I think this is good evidence for the fact that we can have better coverage. And when you look at the home ownership gap, what makes me excited about all of that is that shows me growth potential moving forward. Obviously we have to get through some of the interest rate issues, and there are places where there's a supply problem. But overall, if we start tackling that, having better coverage with these growing populations, I think we can watch that purchase loan, kind of growth chart kind of increase more quickly. With that being said, though, at a state level, you do see, this can show us a couple of things. It can show us differences in, how many applicants of each type are in these different states. But it also does show you that there are places where it makes sense that the loan count isn't as high, or there aren't as many lenders working with a particular group if there aren't as many, but there are places where there are as many, and it's dominated, or that coverage is happening by a smaller group of lenders, which of course that's not a good thing in these situations. And then the last thing I looked at, again, could have taken a million different paths, was I wanted to get a sense of, if we're still talking about race and ethnicity, how do denial rates for each group compare by state? And there were some, the differences. I mean, technically there shouldn't be a difference in denial rates based on the number of, what the household composition is. And I think it accounts for some of the disparity. But when you really look at the differences on the bottom one, between Asian, Black, and Hispanic, the orange is Asian, green is Black, blue is Hispanic, and this is denial rates, you can see that, with the exception of in Oregon and Hawaii, Blacks by far had the highest denial rate, sometimes not quite double, but at least a third higher than the Asian denial rate. And it isn't equal throughout state to state. And so diving into, and you kind of match this with that lender coverage rate, there's some overlap there. And I just always find that to be an interesting look. I know I'm only supposed to take a half hour, so I did that. Happy to keep talking or answer any questions if anyone has any. As far as interesting topics to explore beyond this, I've kind of been doing more work in trying to understand the denial reasons. 5 years ago, credit would have been the number one, without a doubt. Debt to income has become absolutely the primary, solidly the number one reason for denial in every state, with every group, in about every market. What I haven't looked at yet is, does that look the same between the different lender types? That's what I'm kind of diving into next. So that's really all I have from the perspective of today's presentation. But whether it's me, I'm sure many of you know Bernard, he's our COO. There's a lot of other analysis we can do, whether it's for fair lending, just growth strategies, or just you purely being interested. Please reach out. We can talk about this for hours. So if there are any other data geeks out there, I'm always open to a conversation and a sharing of information. So no, Sarah, were there any? I never checked the chat. Were there any questions? I don't think so, right?
No questions. If you guys do have any questions afterwards, though, we will be sending up a follow-up email with Laird's contact information, as well as the recording and the deck. Her email is also in the chat if you wanted to grab that. And thank you, Laird, and everyone for attending. And hopefully we'll see you all soon at TMC's conference in Denver.
Looking forward to it. Thank you, Sarah. Thank you, everyone.
Bye.
Bye-bye.